Investing at all-time highs. Should you do it? Should you wait for a dip in the market? This is a common question that all investors ask themselves at some point throughout their investing journey. Today I'm going to talk about the psychology behind investing at all-time highs and why it can be so difficult. And then also I'm going to pull two examples of different studies that look at the numbers behind investing at all-time highs and give you the truth on if it's okay to invest at all-time highs or if you in fact do need to wait for a market dip. Let's go ahead and get into it. Starting off, it's important that we address the psychology of investing at all-time highs. This is something not a lot of people like to talk about, but when it comes to investing, a lot of things are just a mental exercise, and investing at all-time highs is no different. And you really just want to be able to check your thoughts and your viewpoints with the factual data and make sure that you're not leading yourself in a bad direction. When it comes to markets ripping, there's really two types of people. Person A is someone who is afraid of all-time highs. Basically, they realize, hey, the market is at this level it's never been at before. It's obvious it has to go down, and then they get tight with their money and they aren't sure if they should go ahead and keep investing or if they should pull back on their investing habits and wait for a market dip. This can get you in trouble. Likewise, person B is someone who is excited for all-time highs. This is a person who thinks, the market is ripping, everything is good, money is flowing into the market, we are going to go higher, 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 and higher. This can also get you in trouble because, as we know, the market does go down. And so you don't want to have, all person A's mentality and you don't want to have all person B's mentality. But somewhere in the middle is probably the best place to be. But as far as the psychology when it comes to investing at all-time highs, that's kind of an interesting way to look at it. Another way that you can look at it is that experienced investors often get more nervous at all-time highs than they do when the market dips. As an experienced investor, you know that a dip in the market is a sale and has a chance for you to buy stocks on sale. As a new investor, you might be extremely scared when the market dips. You don't know if it's going to keep crashing. Just from limited experience, you don't have that knowledge that the market is likely going to keep going up over time. Even though you can read about it, you haven't experienced it yet. Versus when the market is at an all-time high as a new investor, it's all rainbows and roses. Everything is great. So depending on whether you're experienced or whether you're a new investor, you can also look at all-time highs differently. That's just a few different type of ways that all-time highs can be viewed in the market depending on your experience level and then what type of person you are, whether you're that A or B person. But no matter which one of those you are, the numbers don't lie. So let's go ahead and get into what the data says you should do when it comes to investing at all-time highs. To start off the numbers section, I want to throw in a little fun fact here, and that is that the market actually spends over half of its time within 5% of an all-time high. Another way to say that is if you went and picked a point on the S&P 500 chart, there's a 90% chance that that value is going to be within 5% of an all-time high. This can be a good thing and even obvious to some as the market goes up over time, but it's just a fun fact to kind of put into perspective all-time highs and how often the market is near these levels. Looking at an actual study, there was one done by RBC Management, and this one actually looked at the total all-time highs by decade. I'll throw the chart up right here, but as you can see, depending on the decade, it really depends on how many all-time highs were seen. And so the 1990s you see has that high of 310. The 2000s though only saw 13 all-time highs. 2010 saw 242, and then now in the 2020s so far as of March 2024 we have seen 104. Obviously this is going to be a little bit higher now in 2025 as the markets continue to go up, but nonetheless you can get an idea there on how many all-time highs we've seen in this decade compared to what has happened in the past. So we're not really even an outlier yet, although we are early into the decade as well too, so that's something to consider. Continuing to look through this study is actually where you come across the chart where they compared investing at all-time highs versus investing at all other dates, and the results of this are honestly extremely surprising. Your average one-year returns investing at all-time highs is 11.2% versus 12.6% at all other dates. Your average 3-year return investing at all-time highs is 10.9%. All other dates is 11.5%. And then your average 5-year return investing at all-time highs is 10.3%. And then for all other dates is 11.3%. So in a nutshell, what these charts tell us is that buying at all-time highs is extremely similar to if you just bought at all other dates. Yes, there's a little advantage of avoiding it, but in hindsight, your odds of actually timing the market correctly to avoid it are very low in the first place as well. So you're better off likely just dollar cost averaging and accepting that small change in performance. And as shown by these numbers, it's really not even going to be that much. Continuing on with this study, they also looked at the odds of a 10% correction happening following all-time highs. Looking at the charts, going out 1 year, only 9% of the time was the market down more than 10%. If we go to 3 years, this drops down to a 2% chance of the market declining more than 10%. And if we go 5 years out, the S&P 500 was never down more than 10% following an all-time high since 1950 when the study was conducted. If you still aren't convinced, I'm going to give you one more great source, and that is the Dollars of Data blog that is written by Nick Magalui, I believe is how you say his name. I might have butchered that, but I've been reading his stuff for years, and it's one of my favorite reads that I read on a weekly basis. I'm going to look at my phone real quick, but I'm going to throw some screenshots up from the article as well too, just to make sure I don't tell you guys anything wrong. But in this article, he took 3 different people. One was a dollar cost averager, which is someone like myself who buys consistent month to month to month, no matter if the market is up or down. He also looked at someone that he calls an all-time high avoider, so someone who avoids all-time highs. And then he also looked at God, or someone who perfectly times the bottom every time when they are investing. So what are the results? 82% of the time, the dollar cost averager actually outperformed the all-time high avoider when looking at a 30-year investing period. And believe it or not, the dollar cost averager actually outperformed God, or the perfect timing investor, 70% of the time in all the scenarios that he analyzed. Hearing that, you're probably wondering, how can someone who times the market perfectly still lose out 70% of the time to someone who is dollar cost averaging? And the answer is really the old saying, time in the market beats timing the market. If you are out of the market or holding money away from the market, not investing it, it does not have that opportunity to compound. If you consistently dollar cost average, keep putting money in the market, compounding is going to work for you the longer that you invest. And so basically, your dividends that you earn, that compounding effect, that is what lets the dollar cost averager outperform someone who times the market perfectly. And a little bonus tip, I'll probably do another video on this in the future, but is that oftentimes the best days in the market do follow some of the severe crashes that happen. So let's say we're at all-time highs, we have a large crash. You cannot time that bottom, but if you try to time it and you miss the best days on the rebound, your long-term return is going to drop significantly. There's a lot of studies out there on this, and I'll probably do another video on it sometime else, but that's another reason that dollar cost averaging is so advantageous, is that you don't risk missing out on those large days in the market that do follow a dip. So that's not really related to the all-time highs so much, but it is somewhat related because, when we have these all-time highs, we have these pullbacks, and sometimes some of the best days recovering from those pullbacks happen very quickly. And not being invested, you will miss those best days, which will hurt your returns over the long run. All that said, the answer is yes, you should continue investing at all-time highs after looking at the data. The advantages of timing the market perfectly are so slim, and your odds of actually doing that correctly are even slimmer. And by dollar cost averaging, staying consistent over the long term, you're going to give your money the best chance to compound and grow. If you haven't yet, go ahead and hit the subscribe button and also drop the like. It would be greatly appreciated by myself, as I'm a new channel, and that lets the YouTube algorithm know that you learned something. Drop a comment if you would like as well too. Thank you for watching. I'm going to go buy some all-time highs. I'll see you in the next video.